Hi everyone, welcome and thank you for tuning in to learn more about our QOZ Fund. I'm Ben Harris, the Vice President of Investor Relations, and I'm also excited to be joined by Michael Episcope, Origin's co-founder, and also Michael McVicker, Origin's General Counsel and in-house QOZ expert. The initial level of interest for our QOZ Fund has been pretty amazing. In the first 24 hours alone, we received more than $100 million in commitments. QOZ has certainly been making many of the headlines in all major news outlets. And so a lot of investors already know a lot about it. But the goal of today is to continue to build on what you already know, and not to focus on all the nitty-gritties of QOZs in general, although we'll cover the basics, but to really focus on the specifics of Origin's QOZ Fund. In terms of the order of business, Michael McVicker will kick off the webinar by discussing the QOZ basics, and then he'll hand it over to Michael Episcope, who will run through Origin's history, the benefits of our fund, the deals in the pipeline. He'll then answer a handful of frequently asked questions before handing it back to me, and I'll run through the terms of the offering and also next steps if you'd like to participate. With that, I'll hand it over to Michael McVicker to discuss QOZ basics.
Thanks, Ben. Before I begin, I just want to read a quick legal disclaimer. The information discussed today is for informational purposes only and is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. The contents of this presentation are not provided with regard to any investor's specific investment objectives, financial situation, tax exposure, or particular need. Nothing presented should be used as the basis for making any specific investment, business, or commercial decision. This is not an investment presentation, and you should consult your personal tax, legal, and accounting advisors before engaging in any transaction. The provision of any service or products provided by Origin Holding Company, LLC, or any of its affiliates is expressly subject to the particular terms and conditions contained in separate written agreements between you and Origin or such affiliate, as applicable. So now I can begin talking a little bit about what opportunity zones are and why they're generating so much interest. Opportunity zones are certain economically distressed localities that were identified by states and then certified by the U.S. Treasury Department. These zones have been created as an economic development tool designed to spur economic growth and job creation in low-income communities. The Treasury Department has certified over 8,700 opportunity zones, which makes them qualified opportunity zones, and these zones are in all 50 states, the District of Columbia, and 5 U.S. territories. Why is there so much interest in opportunity zones? It's basically because the Tax Cuts and Jobs Act, which was signed into law in 2017, created an opportunity for investors to defer capital gains realized from various asset sales if they invest those gains in a qualified fund that in turn makes investments in a qualified opportunity zone. In addition to that deferral, there's a potential forgiveness of a portion of the original gain. And on top of that, there's a potential forgiveness of any new gain. So I'll talk a little bit about that initial gain deferral. If you sell an asset to an unrelated person and realize a gain, and this could be a long-term or a short-term capital gain from the sale of real estate, securities, collectible, art, any sort of other appreciated asset. In that event, you can elect to defer recognition for tax purposes of an unlimited amount of those gains if you reinvest the gains within 180 days into a qualified opportunity zone fund, or QOZ fund. These funds are corporations or entities taxed as partnerships that have a stated purpose of acquiring and owning certain qualifying property in opportunity zones. The investment into a QOZ fund really benefits a long-term investment, and these benefits escalate the longer you hold your investment. So for example, in addition to the immediate deferral of taxes on your capital gains, you may also qualify for a basis adjustment in your investment. Your initial basis in your QOZ fund is zero since you've invested capital gains on which you've paid no taxes. But if you hold your investment for at least 5 years, your basis in the QOZ fund is increased by 10%. It's 10% of the original deferred gain. The effective result is a reduction of your original gain by 10%. If you hold your investment for at least 7 years, your basis in the QOZ fund increases by an additional 5% of the original deferred gain. And this effectively results in the forgiveness of a cumulative 15% of your original gain. The original gain, or the amount remaining after any sort of reduction based on the length of time you've held it, can be deferred until the earlier of the date on which the QOZ fund interest is sold or exchanged, or December 31st, 2026. If sold or exchanged on or before December 31st, 2026, you recognize tax on the difference between the original deferred gain, as it may have been adjusted, less your basis in the investment on the recognition date. Note that there's an imputed recognition event on December 31st, 2026. So if you still hold your QOZ fund investment on that date, you'll need to pay the capital gains tax on the balance of your deferred gain, or the deferred gain with the step-up in basis if you've held your investment for 5 or 7 years. In addition to the deferral and potential reduction in gain, an investment in a QOZ fund also has the potential to appreciate tax-free. If you hold the QOZ fund investment for at least 10 years, you can elect to step up the basis in your investment to its fair market value on the date the investment is sold or exchanged. This has the effect of permanently excluding income from all new capital gains arising from the QOZ fund on the date the investment is sold or exchanged. Investors who invest capital gains into a QOZ fund are eligible for the deferral and forgiveness we just mentioned, but investors can also invest non-capital gains into a QOZ fund, or a mixture of capital gains and non-gains. But if a mixture is invested, the investment will be bifurcated into 2 investments following the type of contribution that's made. One that's eligible for the QOZ fund tax benefits and one that is not. And that's my summary of what QOZ funds are and why they are generating so much interest. And with that, I will pass the mic over to Michael.
Thank you, Mike. Mike has become our resident expert in QOZ, and it's great having in-house counsel. We all sleep better at night knowing that he is adept at the law here. My name is Michael Episcope, and I'm one of the co-founders and principals at Origin. I want to thank you for attending the webinar today, and also thank you for submitting questions in advance. Rather than going over all of the questions at the end of the presentation, what I've done is I've weaved them into various parts of the presentation. So hopefully I will have answered your question by the time the webinar is over. And if I didn't, then please feel free to submit those by email or go into the portal through our website and check our FAQs inside the portal under the QOZ page, because we are constantly updating that, and I'm sure that you will find your answer there. I'll be covering why QOZ and what's happening on the ground, and I'll also go over the fund mechanics, the deal pipeline, and return analysis. Let me start by telling you a little bit about Origin. We were formed in 2007, and in the beginning we resembled more of a family office. My partner and I built this to protect and grow the wealth that we had accumulated in our previous careers. And we built it from the ground up because we believed we could do it better. And from day one, it was always about delivering a truly institutional quality product to the individual investor. And we've held true to that. And I think it's one of the fundamental reasons why we've been able to attract so many like-minded partners to Origin. I'm proud to say today that my partner and I are still the largest investors at Origin. And we invest here because we believe in our deals, we believe in our team, and it's still the place we use to grow and protect our wealth. And we'll be investing significantly in the QOZ fund as well, a minimum of $5 million, and that could easily grow to $10, $15, $20 million as we find gains to harvest over the next 1, 2, 3 years. But I truly believe our success is a combination of not only the significant alignment, but also the results we've delivered and the service we provide as well. Today, we have more than 550 investment partners and manage close to $1 billion in real estate. Those investors are served by 25 team members across 4 offices, and our headquarters are in Chicago. We also have regional hubs in Dallas, Charlotte, and Denver. And those regional hubs are used for deal sourcing. We have a boots-on-the-ground approach. Our team lives and works in their market. And our target markets are Denver, Chicago, Austin, Houston, Dallas, Raleigh, Atlanta, and Charlotte. And we've recently expanded to Minneapolis, Nashville, and Phoenix. And these are some of the strongest growing markets in the country, the fastest growing markets in the country. But even within each market, we then position ourselves in the higher income growth neighborhoods and corridors. So it's really a macro and micro approach to investing, and the boots on the ground, having people in our markets, makes it so we know the entire opportunity set in detail. In terms of our strategy, we focus on assets from core plus to value add to ground up construction, primarily in office and multifamily, but we've also done retail and industrial. So we have a lot of experience across various asset classes. Today, our focus is almost exclusively on multifamily, and this fund will be 100% ground up multifamily. I do want to emphasize one point. Unlike a lot of operators out there, fund operators who act more as a capital provider, we are a hands-on asset manager. We are involved in the day-to-day in every single detail, and that's a big differentiator and something that when you invest with Origin, that's the value that we provide as an asset manager. In terms of our track record, we are a fund operator. We are currently investing our third fund. Our first fund generated a 28% net IRR to investors and a 2.3 net multiple. Our second fund generated a 21% net IRR and a 2.1 net multiple. We are currently investing our third fund, which is a $151 million fund. We are 62% invested today. We have another 3 deals under contract, which will bring us up to 87% invested. That will take place by the end of Q1. And it was really out of the activities of Fund 3 that we became familiar and interested in QOZ. But this brings me to my next point. Why QOZ and why now? What we know is that this is an incredibly favorable law for the investor, and certainly the most favorable one I've ever seen in my lifetime, and we will probably ever see again. But the tax benefits are inconsequential if we can't execute on the investment side. And when QOZ was announced, it started with research and asking a couple of questions. The first question we asked was, are the QOZ areas places we would invest, regardless of QOZ? QOZ deals can't be viewed through a different lens. They have to stand up to the same investment and underwriting criteria. The law itself doesn't make real estate more valuable. It's purely a tax benefit on the back end, and the fundamentals still rule. And what we're looking for are well-located properties we can buy right and execute on. And that's the lens we used in Fund 1, in Fund 2, in Fund 3, and that's the same lens we will be using in the QOZ Fund. The answer to the question, though, are the QOZ areas places we would invest? In most instances, I would say 90%, the answer is no. These areas are not ready for investment today. That could change, but today we wouldn't feel comfortable going into some of these areas, and they don't overlap in areas where we're already looking. But the other 10% is more than intriguing. It perfectly overlaps with the areas where we were looking for deals for Fund 3. These are transitioning neighborhoods in the path of growth. And just to give you an idea of the overlap, one of the deals we just put under contract for Fund 3 in Charlotte, we were working on this deal for about 12 months, and when they overlaid the QOZ maps, it so happened that we were in a QOZ zone. Fund 3 won't get the benefits of the QOZ, but the point of the story is to illustrate the overlap between where we've already been looking and certain areas that have been overlaid with the QOZ maps. Now, the second question we had to answer was, how big is the opportunity and how long will it last? We wanted to make sure we could invest enough capital to make sense of the opportunity and not have a one-off orphan asset, and that we could put people's capital to work in a reasonable time frame. And this question, this is a pipeline question, it's more difficult to answer because it's really about predicting our ability to close deals. What we know is that there is a limited opportunity set because QOZ doesn't cover the entire nation. There are about 8,700 QOZ areas, and of those, about 10% that we would go into. But again, we only cover 11 markets. What we know today is that we have 3 quality deals under contract, and there are other very promising deals in the marketplace. And we wouldn't have announced the fund if we didn't believe there was a 12 to 24-month opportunity in front of us. Now, I do believe that first movers have an advantage, and our existing pipeline and network benefits us substantially. Some of the concerns we've heard from investors is about the rush of capital that's about to hit the market. We've all heard about the mega funds that have been announced, $500 million funds, billion-dollar funds, multi-billion-dollar funds, and that concern is more than valid, and we have it as well. And it might happen. But understand that we will exercise the same discipline we always have. The opportunity set is incredibly difficult to quantify, which is why we didn't rush out and raise a $500 million blind fund. And if prices get bid up to the point where it no longer makes sense, we will walk away. The challenge with QOZ is not in raising money. It's finding enough quality investment opportunities to satisfy the demand. And every fund manager is going to have this same challenge. What we've done to address this is designed the fund with flexibility around the capital commitment process. And I'm going to go into this in more detail in the next few slides. Let's move on now into fund overview. The QOZ requirements dictate that we have to improve the property significantly. And what that means is that the fund will be 100% engaged in ground-up multifamily development. The strategy is what we call a build-to-core model, because once these are developed, we are holding a stabilized asset. And the investment period has to be a total of 10 years or more to take full advantage of the QOZ benefits. The chart you see in front of you illustrates the internal rate of return throughout the hold period. You can see that higher IRRs occur in the beginning while the property is being developed, and then it levels off as the asset is stabilized. What we have is 2 to 3 years of ground-up construction and stabilization, and then the next 7 years will consist of owning a stabilized institutional quality Class A asset. And these are two very different risk sets, and we know how to manage them both. One of the questions we've gotten from many investors, is this a good time for development? I think we've gotten that question in Fund 1, Fund 2, Fund 3, in one form or another, whether it's development or just buying real estate. And we understand the concern. We've had a 9-year run-up. The reality is, though, we won't really know that for several years. What we do know is that new deals are more difficult to pencil in today's environment because of higher interest rates and lower forecasted growth rates. And it is likely that the market does pull back in the next few years. But we have a 10-year or more hold period. And what we know is that institutional quality real estate has never lost money in any 10-year period. And there's a big advantage of being in a fund and having your money spread across multiple deals. Every individual deal will be an institutional quality Class A asset. and it'll be capitalized with 30% to 40% of equity. Let's move on to the fund structure, and I'll talk about how we're going to handle capital commitments and the timing of capital calls. The commitment or capital call structure, if you will, that we've designed is really a hybrid between a traditional capital called fund and a deal syndication where you call capital as you find a deal. And here's how it works. We are creating a series of $100 million tranches. Your commitment will be assigned to a tranche. And I'll go over that in a second, how we're assigning the various commitments. But each $100 million tranche will be fully invested prior to us calling capital from the next tranche. So 100% of the capital in tranche 1 will be called before we call any money in tranche 2. And then, once we do call all that capital from tranche 1, tranche 2 will immediately move up in the queue. Once we've fully satisfied those commitments, then tranche 3 will move up in the queue. And today, these first 3 deals will require around $100 million in equity, which means tranche 1 investors will get to invest 100% of their equity. Now, it's very likely that we find more deals. The challenge is we don't know today if we have a need for $100 million, $200 million, or $500 million in equity. We think this is a far better way of doing business. It's better than raising a $500 million fund and risk investing 20, 30, 40% of everyone's capital. The opportunity set is just too difficult to forecast. So what we know today is that we can take 100% of tranche 1, and the goal is to satisfy the commitments in tranche 2, tranche 3, and so on and so forth. I do want to point out that there are no fees for joining the queue. We've done away with committed fees in this fund, so there's no obligation whatsoever, except for the fact that we are asking people to sign subscription agreements at that time when they move up in the queue. Now, in terms of how one gets selected to a tranche, we are giving priority to Fund 3 investors. Fund 3 investors would be part of tranche 1, and then we will take people from the wait list, and it's based on the order they sign up, which is important. I encourage you to add yourself to the wait list as soon as possible because that timestamp will dictate how we allocate your position. Now, the wait list has absolutely no obligation, but please go in, if you haven't already registered, go into the QOZ Fund page and look for the most recent documents. Next, I'm going to cover the deal pipeline, but I'm only going to talk about the deals that we have under contract today. The first deal I'm going to talk about is located in Denver. And Denver is a market we've been covering for about 8 years. In fact, one of our regional offices is actually in Denver. And Denver is one of the fastest growing markets in the country. In the last month alone, 2 public REITs announced that they were increasing the size of their portfolio in Denver. And even bigger news than that was hearing Equity Residential is actually moving back into Denver. They actually left Denver about 10 years ago, and they recently made a strategic decision to come back in. What we're going to be developing in Denver is a 400-plus unit multifamily anchored by the University of Colorado Medical Research Facility. That's home to 40,000 jobs and one of the fastest growing medical facilities in the country. This deal is actually further supported by a $15.5 million TIF as well. Now, I talked earlier about the areas, how QOZ overlaps with many of the areas where we've been already looking. And this deal is an example of that. This was actually sourced for Fund 3, but the equity required was actually too large of a commitment for Fund 3 alone. So both funds, the QOZ and Fund 3, will be investing in this deal together. The other project we just put on our contract is in Charlotte. And these are 2 adjacent land parcels north of the city in an area called NODA. And NODA means north of Davidson. And this is a thriving infill neighborhood today. These are transit-oriented developments that sit right along the newly built rail line, and I think you would call these an exception to the rule when it comes to QOZ. I would call Denver and this an exception to the rule. These are transitioning neighborhoods in the path of growth. Charlotte will be a phased development, and we can build more than 1,000 units on both of these parcels. And the plan today is to build a total of 4 buildings between 250 and 300 units each. And what we're going to do is phase those developments out over the next 1 to 3 years to manage our risk. I want to be clear about one thing, that these projects are underwritten to the same standards as we've used for the last 10 years. And I think that's evident by the fact that the QOZ Fund will be in the Denver deal alongside of Fund 3. We're excited about both opportunities, and the goal is to find even more opportunities so we can continue to expand the size of the fund. Let's move on now, and I'll talk about how we are going to manage the capital call process and the timing of capital calls. We've gotten more questions about the timing of capital calls than any other subject. And it makes sense because the 180-day rule means that you have to invest in the fund within 180 days of your gain being recognized. Now, I do want to be clear that everybody's tax situation is unique, and there will be no way for us to accommodate everybody's unique situation. Our role is to make sure the fund is compliant with QOZ law, and as an investor, your role is to make sure that your own personal situation is compliant. Now, capital calls and harvesting gains don't always match up, so what we've done is built flexibility into the fund. What you see in front of you is a chart based on the theoretical timing of capital calls based on the deals that we currently have on the table. This could accelerate if we find more deals, but I'm using this as an example to illustrate how we built flexibility into the fund. What we know is that we'll be calling 25% of the first $100 million tranche in December of this year. After that, we also know that we'll need another $25 million in May. Now, for those of you who have harvested gains in 2018, the 2018 capital call may fall within that 180-day rule, but the 2019 May call may not. Those gains may have expired and be beyond those 180 days. What we're allowing people to do, and we will send this out in our communication when we call capital, is we have an optional funding period. If you want to fund 50% of your capital commitment in December of 2018, we will allow that. And what that does is that at the time you invest in the fund is when the investment occurs. It's irrespective of when we make an investment in the project. And this money is held aside as what we call working capital. And that's actually a definition under QOZ law, that we can hold that capital until such time we invest it, and we have up to 31 months to fully invest that capital. So from our perspective, we just have to make sure when we're taking working capital that we fully intend to invest it in a project in a reasonable period of time. The working capital that is funded will be set aside, and that won't be subject to our asset management fees, and it also won't be subject to the pref until such time that we actually call the capital or invest the capital. What you also see on the right-hand side of the chart is an optional funding period starting in December of 2019. This is for the phased developments that we're doing in Charlotte, and we will be calling capital at different periods of time along that continuum. If you harvest gains at the end of 2019 or any time along that continuum, and you'd like to lock in the QOZ benefit, we will be able to accept that capital as working capital during that period. And we will communicate with investors during that time about how much working capital we currently have and how much we need. Because again, we have to make sure that any working capital we take in will be invested within that 31-month period. The capital call structure has been designed with flexibility and optionality because we understand that everybody's tax situation is unique, and you can't always time when gains are harvested. Oftentimes, that is outside of your control. Let me now jump to the return analysis, where I'm going to compare a QOZ investment to a non-QOZ investment. This is an after-tax return analysis of the QOZ investment, and it really illustrates the benefits of this tax break. Now, what we're comparing is a $1 million non-QOZ investment to a $1 million QOZ investment. And if you go to the top right of the chart in front of you, you'll see that the fund net multiple on a pre-tax basis is forecasted to be a 2.6 net multiple, and the net IRR, the internal rate of return, is 14%. Now, what a 2.6 multiple means is that if you make $1 million investment, you can expect $2.6 million back on a pre-tax basis. For those of you who have been investing with us long enough, you have probably heard us talk about how difficult projections are, and we understand that everybody wants them. The only thing I want to say about the returns is that it's hard enough to predict returns a week from now, a month from now, 6 months, 3 years, 5 years. This is a 10-year projection, and this is a base case. As a fund manager, we are going to do everything in our power along the entire time we own this to maximize the value of this asset. There are 1,000 variables that will impact this return, and this is a base case return that we've put together for your own reference. Where this gets really interesting is the QOZ after-tax multiple jumps from a 2.6 to actually a 3.15x, and the QOZ after-tax IRR goes from a 14 to a 17.3%. And that IRR is a little bit impacted in the fact that we are going to be holding stabilized assets that will be cash flowing, so some of your return will be coming back through cash flow in years 3 through 10. We're still waiting for guidance from Treasury about how refinancings are going to be handled, and we expect that refinancings will be allowed, but we'll know more as Treasury provides us with guidance. Now, if you go to the chart on the bottom right and you start on the left-hand side, you see non-QOZ money. On the right-hand side, you see QOZ money. I'll take you through this line by line. In both cases, you have a capital gain. And we're comparing a $1 million non-QOZ investment to a QOZ investment. The non-QOZ investment has to pay capital gains tax in the year in which the gain was incurred. So that leaves you with an after-tax investment of only $762,000. The QOZ investment, that capital gains tax, is actually deferred for 7 years, and that doesn't have to be paid until 2026. And if you invest before December of 2019, you actually get a 15% discount on the $238,000. So your tax liability, if you go all the way to the bottom on the QOZ column, you see $202,300. That's your tax liability in year 7. The way I look at that is that's essentially a low interest loan and a negative interest loan from the government that you can use over that period. The net tax deferral is worth about $400,000 to the investment. Let me jump down. The year 10 value is simply the multiple of the fund at that point in time. Now, the non-QOZ money will have to pay capital gains tax on the profit, which is the difference between the year 10 value and the after-tax investment. And the capital gains tax comes out to around $290,000, which leaves you in total cash flow, your year 10 after-tax value is $1,691,000. On the QOZ side, your entire investment grows tax-free. So that $2.6 million, if you look at the year 10 after-tax value, you have to deduct the $202,000 that you're going to be paying in year 7. Your after-tax value in year 10 is $2.4 million on the QOZ side versus about $1.7 million on the non-QOZ side. So by using QOZ money, the benefit is about $700,000 when you're investing $1 million. And that's how the multiple goes from 2.6 to 3.15. In most instances, the cash flow is going to be about 40% greater in a QOZ investment, and the profitability is going to be well above 50% by using QOZ dollars. I think this illustrates the power of the tax benefit, and you can start to see why people are so excited about the tax benefit and why we're excited about the tax benefit as well. And I do want to be clear that non-QOZ money is perfectly eligible for this fund. You don't have to have QOZ money. It can be a hybrid. Obviously, if you have QOZ money, there's a huge advantage of investing that. And maybe I didn't emphasize this, but not only is the original tax deferred, but the entire QOZ investment grows tax-free so that you don't owe any taxes except for the deferral amount. And that's one of the greatest things. So if the fund does a lot better than this, then your gains will be exacerbated even further. I want to thank you again for listening to the webinar. I'm going to hand it off to Ben Harris now, who's going to go over the fund terms and then talk about next steps. Ben?
Okay, great. Thank you, Michael. So now that we've covered the fund in depth, I want to run through the terms of the offering. Similar to the rest of Origin's funds, Michael and his co-founder David Shear will be co-investing significantly alongside all other investors. At minimum, their amount will be $5 million of their personal wealth at the same terms as everybody else. Also, like the rest of our funds, we'll be offering institutional pricing to individual investors. The fund will have a one-time upfront admin fee that will range from 0 basis points to 200 basis points, depending on how much capital you commit. The fund has a 50 basis point acquisition fee, then there's a 150 basis point annual asset management fee. There is no commitment fee, though, so you will not be charged on your commitment until your funds are actually invested. There's also a 15% performance fee after a 7% preferred return and a 50-50 catch-up are achieved. From an administrative standpoint, the fund will have a third-party fund admin. They'll handle all contributions and distributions, so Origin will not handle cash. The fund also does have a third-party fund auditor. I want to note that the QOZ fund is long-term in nature and is expected to last at least 10 years without liquidity. It's at least a 10-year hold because of the QOZ laws. We want to make sure that we're taking full advantage of the tax benefits. In terms of next steps, if you are interested in the opportunity but have not expressed your interest to us yet, then you can check out the description section of this video and click on the hyperlink, or go to origininvestments.com and click I'm interested and fill out the form. If you have already expressed your interest, then in the coming weeks we'll be sure to send you an investment summary and also a private placement memorandum. As for fund capacity, we hope to accommodate as many people as possible. By the end of the year, everyone who expresses interest will be assigned to a specific tranche, much like the ones that Michael described earlier in the presentation. Current Origin investors will receive priority tranche access to new investors. That concludes our QOZ Fund webinar. Thanks for joining us, and we look forward to partnering with many of you soon.